The market keeps defying gravity, and Urian Timmer, Director of Global Macro at Fidelity Investments, says that can and likely will continue well into next year.
This is now a global bull market, which actually is a very nice thing to see from an investing point of view. So the tariffs are there, they're happening. We're not quite sure who's paying for them. Certainly, profit margins are making new cycle highs as we speak. And the CPI data are not quite really showing the tariffs yet. Doesn't mean they won't. But again, it's a matter of offsets, right? Like if inflation goes up because of tariffs, but it goes down because of oil prices, then one can offset the other.
That's from a wide-ranging big interview. But we start today with Todd Rosenbluth, head of research at Verify, talking about a brand new ETF that uses an option strategy to deliver income on the technology sector. Plus, Derek Ober is here to discuss a Northwestern Mutual study, which showed that more Americans plan to leave an inheritance, but somehow fewer Americans expect to actually receive one.
Here comes the good part.
I don't know, maybe the good part's where you actually get to hear from those guests, but we've got a minute or two before we do that. This is Money Life, and yeah, I hope the whole thing is good parts because we've got a great show planned and executed for you today. Urian Timmer, Director of Global Macro at Fidelity Investments, is here. It does not get much bigger than that, but a great ETF of the week. Whether you like that segment, I know that some of you don't. You think, well, you do it every week and it's kind of whatever. Look, this one particularly important. And in fact, we got in a question from Tristan in Bellevue, Washington, who wanted to know a little bit about some of the option strategies. Well, you literally have a brand new fund, like just out of the box, ETF of the week, because it's part of a suite of funds. And Todd wanted to focus on that. But there's been a lot about options income strategies, where people are using options on an ETF. So you take something like a few weeks ago, it was the SPY-I, which is basically the spider, the S&P 500, the SPY, SPY, S&P 500 with an options overlay that delivers big income and much of, but not all of the upside return of the S&P 500. And so there are questions, and we will ask one from Tristan today. Basically, are these strategies too good to be true? Now, you can imagine if Todd is picking it as the ETF of the week, he does not think so, but it doesn't mean the discussion's not worthy. So, yeah, you might think option stuff is hard to understand. Trust me, the yields on these are super attractive, and you definitely want to understand how they work before you do them. So we've got that. We've got this interesting study. Yeah, more Americans are expecting and planning to leave an inheritance, but fewer Americans are expecting to get one. There is a communications gap there. And yes, you want your heirs to understand how it might happen and what might be coming their way. In the past, we've had it be the other way where people were expecting an inheritance and then they were going to be disappointed. In this case, at least, they will be happy about it if they get one that they weren't expecting. I'm Chuck Jaffe, financial columnist, your host on this show. I had something very scary happen last night. After midnight, was up and working on this show, and all of a sudden my computer shows on both of my big screens a thing that basically says, hey, we're updating, don't touch things. Now, you can get one of those, but this was not scheduled, and this was different because normally when it does that, the computer's kind of in a reboot mode, and it shuts things down for me on one of my screens. It didn't do that. And as I'm looking at this thing going, well, that's really weird timing and no warning, I see a mouse moving, and I can't tell what's going on, but it's not going out. It's not going away from me. And it says, don't do this. It's got a bunch of Microsoft stuff there. It's real enough that you can say, oh, I've seen this before, and yet it doesn't look real to me. And I've got plenty of stuff that's supposed to protect me and firewalls and whatever. So I'm watching this mouse move, and it's not showing me what it's doing. I can't see keystrokes. Whatever's happening, I can't see. And even though it says don't stop things or what have you, I'm like, no. I'm either turning my computer off, I'm going to crash my own computer, or I'm going to at least lock up the system and see what happens. So I hit Control-Alt-Delete, which is how you basically can go to lock or shut down your, and the mouse moves over to cancel because it puts up a screen, and the mouse moves over to cancel that. And I hit it again, and it tries to stop this from happening again. Now you could go, oh, is that the system trying to stop me from making some mistake and rebooting or whatever? No, this was scam. Now, the good news was after I basically got that done and they realized they had been uncovered, they gave me just enough of a break that I was able to do that and then brought it back full diagnostics. I'm also going to be looking at things like all my credit cards. I have really only one card that I use online. I do that intentionally. But for example, this week I did use another card, not because I wanted to, but because I'd been told by my institution, if you don't use it, we will we will close it. And it had been around for like a million years. And I didn't want to take that hit on my credit score. It's not a card I'm going to use very often, but I've had it for 30 years. So I did use that card this week. I had done a couple of things. Like I don't know what made it happen, but I can promise you, okay, let's upgrade everything and take a look at everything because that was scary. And if you see it, you need to make sure, like, there's so much scamming going on these days, whether it's on your phone, on your computer. This one was really frightening because at my desk, I literally watched and I'm like, this looks like somebody's got control of my computer and it isn't me. So if you're seeing any of this stuff happen in your setup, protect yourself. When in doubt, understand that, had this been a legitimate thing, well, they don't want you to reboot, but generally speaking, you're going to be fine if you do. And even if you're not, making it that you have to somehow do something with your computer to get it, take it to a technician, well, that's a huge pain in the butt, might be a lot better than identity theft and all the other things. So yeah, I'm going to be watching all that sort of stuff to go, okay, is there anything here that's going on coming out in my name, et cetera? I'm heightened alert because of what happened, even though I know I stopped it within a minute. There was, I don't know how fast they can be. That's the thing. You never can tell, but super scary. Have you had experiences like that? Can we help you with something like that? Or are you worried or wondering? I'm pretty good at figuring out the phishing stuff and all that other sort of things. But if you've got stories and you're looking for help on how you recover from that or anything else, make that one of the questions you ask me. But you can ask us about anything. We would love to hear from you. Also, tell us what you think about the show, the guests we've got, what you want to get more of, what you want to get less of, et cetera. Chuck at moneylifeshow.com is how you reach me. But right now, don't reach for anything, and particularly not for anything that stops this show, because we have 3 great guests. It's Todd Rosenbluth, then Derek Ober, then Urian Timmer, Director of Global Macro at Fidelity. It is a great day to live the money life, and I promise we'll be proving that when the talk starts next.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
One fund on point for today, the expert to talk about it. This is the ETF of the week. Welcome to the ETF of the week, where we examine newsworthy, trending, unique, and intriguing exchange-traded funds with Todd Rosenbluth, the head of research at VettaFi. And if you go to their website, VettaFi.com, you will find all the tools and research you need to make yourself a savvier and smarter investor in exchange-traded funds. Todd Rosenbluth, great to chat with you again.
Great to be back.
Your ETF of the week is
The Technology Select Sector Spider Premium Income Fund, XLKI.
XLKI, the Technology Select Sector Spider Premium Income Fund. Ooh, Todd, I got a lot of questions because this is a brand new fund that is part of an entire portfolio or suite of brand new funds that are using options to deliver income on basically select sector spider ETFs. So explain how these work and why you're making this one the ETF for the week now.
Well, you just made my job easier. You just partially explained what this is. So this is going to own XLK, which is technology stocks in the S&P 500. So Apple, NVIDIA, Microsoft, among the other stocks that you'd find in a market cap weighted approach. We can come back to whether or not that's the right way to get exposure in this market. And then it's going to use options to generate income. So whereas the technology sector spider is yielding roughly 1%, in fact, the overall S&P 500 is yielding just over 1%. We expect that XLKI is going to offer a well above average income, 7-8% yield. We think we'll see. This fund is brand new. It only has $1 million as you and I are talking about it. So it's still likely to build an audience. We believe, we think there's a need for income. We think there's an interest in income. We've talked about options-based strategies beforehand. This is the technology way of getting exposure to that.
Like I said, it's part of a suite. So you picked technology, but you could have picked consumer discretionary. That would have been XLYI, or energy. You could have picked XLEI, or healthcare XLVI, and so on and so forth. So is there a reason why you particularly like the energy play right now?
So I particularly like the technology play in XLKI in this conversation. And the reason I do is everybody seems to like technology. We saw Nvidia continue to climb higher. It's now 8% of the S&P 500. Microsoft continues to climb higher. We're seeing strong interest, renewed interest in growth stocks and technology stocks. What this ETF will likely do is provide some downside protection through the use of options. It will not climb as high as XLK, the technology sector spider, because using options, it's going to limit some of that upside, but also generate additional income. So we think the Fed is likely to be cutting interest rates later on this year. People are continually searching for income opportunities. This is a way of getting tech exposure and income. And I just want to note, maybe you're going to get there. We've talked, I believe, about NASDAQ-based option strategies. The NASDAQ is not all technology. NASDAQ is mostly technology, but it's also consumer discretionary. There's some healthcare stocks within. If you want tech and income, XLKI is the way to go.
Everyone loves income. Like, income is not something that investors fight against. So we should point out there is some measure of a price you pay for the income, in that if the underlying ETF is booming, you love technology, and technology is, on a rocket towards record highs, you will not expect to beat that with this kind of a fund, right?
Correct. So if this fund is less likely, it's possible, but less likely to outperform its original fund XLK in a bullish straight up market. If there's volatility is a good thing when you're using an options based strategy to generate additional income. So that could help. If technology is flat or down slightly, but you still want to have exposure to it, then this is a way to go. And to just get in front of potentially another question, because I know you had a list of questions, so let me see if I can tick off some of them in advance. You own technology stocks in a broader S&P 500 portfolio. It's the largest sector. It's if you want to overweight exposure to technology and you want to have income joined with that, then this is a good way of going. But you own S&P 500 technology stocks through your S&P 500 base ETF like SPY or SPLG.
And I would imagine if what you were looking for was income from everything, that rather than pick a sector or two, you would just go back and, as you said, do the spider version, the SPY, which has been ETF of the week, or do the Q's or something along those lines that gives you income off of everything and basically puts the options overlay on the whole market.
That's right. So this is targeting the exposure to the technology sector. In the case of XLKI, you referred to some of the other sibling products that came to market. If you wanted to have income with healthcare and an overweight, or income with consumer discretionary, then yes, there's a number of products that offer broad market exposure, and they've been increasingly popular. We've seen covered call or premium income based ETFs gain in popularity this year. We're hearing from a lot of advisors and investors that are interested in them. We want to give a range of different strategies to consider.
We are seeing, and you and I have discussed, a lot of covered call ETFs being created, and it's the new edition. And as you pointed out, these are brand new. This fund, as we record it, has virtually no money in it, but you're not worried that this fund is going to get there in part because of the sponsor. As we see new covered call ETFs, do they have new fund phenomenon where they work particularly well when they're small, or do they struggle because with an option strategy, you want to have more liquidity? Is there any reason why with funds of this ilk, even if it's not XLKI, that you want to see some critical mass before you're willing to commit to a new fund?
I don't think so. I mean, State Street launched a suite of 11 of these products. I feel they're committed to having these products have a chance to be successful. The holdings are quite simple. This owns XL, or this being XLKI, owns XLK and then owns options. Is that simple? So we think this can gain scale. I would note that this is a more expensive version than getting exposure to XLK. This is 35 basis points. So you are paying for that options overlay, that premium income as part of the portfolio. You're hopefully going to get rewarded many times over in the form of income from an above average dividend yield. But I don't think it's too early to take a closer look at this. Obviously, we're early. $1 million means almost nobody has invested in this by the time we're recording it. Hopefully, by the time where people are listening to it, it's a little bit larger.
Yeah. Well, again, that's only a day or two between recording and when people will hear it. You just talked about the expense ratio. Of course, the higher expense ratio is what you're paying to get the options exposure. The structure, it's basically passive investments in the index, but active when you add the options overlay, because options have to be somewhat active, right?
That's correct. So you're getting the benefits of both the active and passive together. And that's how we're seeing many, not all, of the covered call ETFs, in that the active management is the options overlay to generate that income. But the technology sector within the S&P 500 is relatively well understood in getting exposure to NVIDIA and Microsoft, Apple, Broadcom, Oracle. I'm naming some of the technology stocks off the top of my head. You get that through this ETF in a passive manner. You just get the benefits of an options overlay.
Last question here, and it actually comes from one of my listeners on Money Life, Tristan in Bellevue, Washington, who says he's very intrigued by the new crop of covered call ETFs. And he wrote this before State Street came out with this new crop that we're talking about. Says everybody seems to be living off of all of the covered call income, et cetera. He wants an expert's view because he says they seem too good to be true, but maybe if you understand more about it. Well, you do understand more about it. So on these option strategies, when a consumer is out there hearing something that makes them think, is this too good to be true? Well, you just picked this as ETF for the week. So look them in the eye and tell them, is this too good to be true? How do you make sure that what we're hearing about option strategies is not too good to be true? And what would be your worry in owning one of these about what could go wrong?
So I'm looking straight ahead and saying, I feel good about these strategies and what they're aiming to deliver. I think in that note, because you shared it with me in advance, some of the ETFs that were listed in there were ones we talked about from NEOS. SPYI, I believe, was one of them. There's a track record that just shows the monthly distributions that are paid out for that ETF. If people want to make sure that they're getting that with XLKI, then you maybe want to wait a month or two to see what that yield is going to be. And yes, we're guessing what we think that yield is going to be. People may want to wait till we get to the end of the month, 1 month forward, so they can see what that income distribution is going to be. The proof is in the pudding. These covered call strategies collectively have delivered the income as expected. You get the experience of that's different from the broader market because of the options overlay, but it's still a good experience.
It's the XLKI, the Technology Select Sector Spider Premium Income Fund, part of a whole new family of ETFs, and the ETF of the week right out of the box from Todd Rosenbluth, head of research at Verify. Todd, great stuff. Thanks so much as always for joining me.
It's always my pleasure.
Todd Rosenbluth is head of research at Vetify. Go to vetify.com to get more information on the funds we talk about or on funds ETFs in general. We're just getting started on the Thursday, August the 7th edition of Money Life. Later, I'll be talking with Urian Timmer, Director of Global Macro at Fidelity Investments. But up next, Derek Ober is here discussing a Northwestern Mutual survey about inheritances. How many people expect to leave one versus how many people expect to get one? Yeah, you could be rich with information. Just stick around for that.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Now Money Life takes a look at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money, what they're thinking about when it comes to their finances, and much more. And today we are digging back into the 2025 Planning and Progress study from Northwestern Mutual. It is a really interesting, comprehensive study that brings out a lot of different things. And today we are looking into inheritances because if you know the headline numbers in this country, we've got a wealth transfer that says $90 trillion is going to wind up changing hands. And, well, that changeover affects a lot of people in a lot of different ways. But the interesting thing is, to me, that the study found more people, significantly more than a year ago, are expecting to leave an inheritance, but fewer people, and significantly fewer, are now expecting that they're going to get one. Here to discuss it, Derek Ober. He is a wealth management advisor at Ober Financial, which is a Northwestern Mutual private client group company. You can learn more at northwesternmutual.com. You can dig into the Planning and Progress study by following the link that's in our show notes on our guest page where you find Derek. Derek Ober, welcome to Money Life.
Thanks for having me. Excited to be here.
I mentioned a $90 trillion wealth transfer. Even though we know that that money moving is inevitable, I found it fascinating. There was this big jump from the 2024 Planning and Progress study in terms of people who expect to leave an inheritance. It went from 25% of all respondents in 2024 to 31% this year. But there was a corresponding and surprising 5% drop on the other side, where a year ago, 25% of respondents expected an inheritance. In other words, last year it was balanced. 25% expected to leave one, 25% expected to get one. Now, this is 20% expecting to get one. So those are two things that shouldn't be moving in opposite directions, right? Like if times are good and more people feel good about their ability to leave something behind, you'd think more people would feel good about their potential to get something. So what's going on here? Like why opposite directions now?
It is very interesting. I think it shows some optimism about some folks who are leaving a financial legacy, their personal financial planning, but then maybe some skepticism on the other side of, the next generation being like, hey, is my parents actually leaving some funds for me, right? Am I actually going to receive that inheritance? So there seems to be a little bit of a disconnect, like you're saying, right, between the next generation and the current one planning to leave those funds. So, maybe that leads to, maybe there is a communication gap there or an expectation gap of some type, to be sure. It'd be interesting to see if that trend continues moving forward. But, there's obviously more confidence for folks who are planning to leave an inheritance that they are going to do one. Up 5% from 26 to 31, but clearly there might be some generation 2 skepticism there, like you're seeing in the numbers.
I have to think that it's like two different sides of the coin where you get the people who are expecting to leave one are going, hey, the market's at record highs. Like they're looking at the hard data that has been keeping the economy going. They're going, things are pretty good. Market's at record highs. And the people who are not expecting to get one, they're looking at the soft data, the inflation and the sentiment, and they're going, market may be
Yeah.
at record highs, but things are pretty miserable, and I think there's trouble coming. So, I'm not going to get anything. Like, I wonder if they're sad sacking here as opposed to, is that a possibility?
It could be. It could be. Some of the reality of miscommunication, right? Maybe a lot of the generation that's planning to leave gifts don't expect an inheritance. And again, the adults planning gifts doesn't mean they're necessarily going to be going to the next generation. Those gifts could be also charitable interests as well. So there could be some disconnect in the numbers there from the inheritance in the sense of giving it to the next generation. They're like, I'm going to expect less people are expecting the money, but more people are planning to leave money. And maybe some of that is, hey, we're giving it to charitable interests instead. So there could be some of that in there. Be interesting again to see if that trend continues into further years. But I think it is interesting. And I think advisors need to make sure that, again, they're talking with their clients, communicating this to the next generation and making sure that their clients are doing the same.
Well, yeah, they need to talk. I was going to ask, how much of this is because people don't talk enough about money with their family? Like, what percentage of people who expect to receive an inheritance expect it because mom or dad, kind of said something about it? And also, beyond that, how much of this disconnect is maybe about doing financial planning? Because while people are planning to leave behind an inheritance, doesn't mean they've got a will and an estate plan.
Exactly. Yeah. Only 60% of Americans who plan to leave an inheritance have discussed their plans with family. So, that other 40% could account for some of that gap and the disconnect between those top line numbers there. Certainly having a will is important too. I see this day to day in my own practice is that's usually one of the gaps that we see is that people actually don't have a will or any type of document in place, much less actually communicated it with the next generation. So again, a lot of this is communication issues, right? Which certainly is something that an advisor can help with and lead to more confidence, both in the people leaving the gift and the next generation receiving that inheritance.
Is there also some reluctance on parents? Like they don't want their kids to wind up losing their motivation and living off an inheritance? Because in Real Wealth, they talk about, the first generation makes the money, the second generation stewards the money, and the third or the fourth generation blows it. So, you want your children to grow up with all the right things before you then bestow them or have them relying on an inheritance. Is that part of it as well? Like, I won't, you go off and make your money, and what you get from me is a bonus because you'll have all the work ethic and the rest of it.
Yeah, the shirt sleeves in 3 generations, right, is a real thing. So the study does say that 77% of parents feel comfortable involving, their children in advisor meetings to instill good financial habits. I would question either how many advisors are actually doing that and how many parents are actually executing on that. Just because you're comfortable doesn't mean you're doing it, right? I feel like if folks were doing that more often, that maybe that gap would be less, right? There'd be a little bit more insight. People would feel more comfortable leaving funds to that next generation because now they know, right? They've seen it with their own 2 eyes. Their kids, that next generation, they're going to have those good habits. So I think actually executing on that, because if 77% of people feel comfortable doing it, right, then let's actually make it happen for folks.
Well, the other side of that is that the study finds that among those expecting to receive an inheritance, almost 60% said it's critical or highly critical to their long-term financial security. So if you're having that family discussion, you get as a sense of, I need an inheritance, as a parent, I'd think you might want to be doing something while you're alive. Like, it's great to leave something behind, but I would think it's even better to say like, hey, I got to watch the fruits of my labor pay off.
No. And that 100% relies on them executing, having good financial advice, a good advisor that's willing to have those conversations with the children and grandchildren that they're leaving those funds to, and having that, really that support and that family continuity to the next generation. So I agree. I think that generational wealth planning conversation needs to happen earlier with a lot of these folks who do care about it, right? If it's critical, then those conversations need to happen. And so one of the focuses, I think, coming out of this study for advisors within Northwestern Mutual System, my own practice, is that it's all about asking a couple questions. Just, hey, how does generational wealth planning matter to you? Does leaving an inheritance matter to you? And if so, how can we actually start having these conversations today so that both the generation one and generation two, three are prepared for this type of wealth transfer? I mean, it is a lot of money. I mean, we're talking about $90 trillion here, right?
Yeah. Yeah, it is a lot of money. And more importantly, rather than is if it's happening in your life, well, then it's a lot of money that you want to make sure the right things happen with it for you, your family, your successors, or those charities that you might be giving it to. So the planning conversation, really important. This conversation was great. Derek Ober, thanks so much for joining me on Money Life.
Yeah, thanks for having me.
That's Derek Ober. He is a wealth management advisor. He runs Ober Financial, which is a Northwestern Mutual private client group company. And again, we've been talking about Northwestern Mutual's 2025 Planning and Progress Study. You can learn more at northwesternmutual.com. You can get directly to the study by following the link in our show notes. And you know what you should be planning for now? More of Money Life, because we'll have some for you right after this message. You can count on it.
Verify is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at Verify.com.
It's time for the big interview on the August 7th edition of Money Life. Returning to the show today, Urian Timmer, Director of Global Macro at Fidelity Investments, which means they don't get much bigger than this big interview. But if you want to learn more about Fidelity, it's fidelity.com. And if you can get to Urian's commentaries, definitely worth a look. But right now, you don't have to go anywhere for it because he's here. Urian Timmer, welcome back to the show.
Great to speak to you, Chuck.
These are times when everybody's been looking for some measure of certainty, calmness, how it's all going to play out. But as director of global macro, there's so many things going in different directions. Help us understand just how unusual are these times, because we want to believe that we're living in unusual times. But you've been doing this for a while. Is it just maybe different headlines, but the same old stories?
In some ways, it is the same old stories, but there's obviously always a new twist. And, we know history doesn't repeat, but it does rhyme. And I've been in this industry for 40 years now, at Fidelity for 30. So I've seen some things. I've been through 12 bear markets, I believe. But this is a doozy, right? It's very on point for 2025 that we're dealing with all the cross currents that we are. And, a lot of them we could kind of see coming last November with the election, but then you kind of wonder, is it all bluff and talk? And of course, here we are, some 6 months, 7 months, 8 months later, and we're living it, right? So the cross currents are obviously the tariff tantrum we had in April. It kind of went away, and now it's kind of come back, and trade deals are being made or not made, and deadlines are being passed, and obviously that creates uncertainty for corporates in terms of how much money are they going to spend, what is their cost. Tariffs are a tax on imports. Basically, it's an import tax, and someone's got to pay the tax, and we don't really know who it is, whether it's the consumer through higher prices or the importing companies through lower margins, maybe a little bit of both. Maybe it's the exporting company that has to eat the cost. Maybe there are other offsets like lower oil prices or currency changes. So it's a very hard thing to pinpoint. But on the other side of that, we have clearly an earnings boost coming from the Big Beautiful Bill, which has very generous treatments for like depreciation expenses and obviously the tax implications. Then we have the deregulation. We have the AI boom, which is clearly fueling earnings for the big tech companies. So again, talk about cross currents, right? They're all kind of moving in opposite directions. And what we're seeing right now through first quarter or second quarter earnings season is that this has been a blockbuster earnings season. The increase in the growth rate expected for second quarter earnings has jumped by about 700 basis points or so, which is quite a lot. So right now the bulls are winning that battle. But then on the other side, we have, obviously interest rates, which occasionally push against 4.5% when they move up. Right now, they've backed back off because we have a little bit of a growth scare with the payroll report coming in soft, and today or on Tuesday, the ISM services. And then we have the Federal Reserve, of course, which has some room to cut rates, but not a lot, by at least by my estimation. Maybe a couple of rate cuts, and Jay Powell, rightfully, I think, is holding his powder dry because the inflation dragon has not yet been slayed. It's still sticky at around 2.8. And at the same time, we have obviously a lot of political pressure for him to cut rates. And, I mean, this is a deja vu from President Trump's first term when we had the same kind of rhetoric going on. But it has a little bit more bite this time because Chair Powell is exiting the scene in less than a year. And so we have all of these factors going on. We have this huge fiscal dominance kind of trend going on where the deficits are sky high, are going to continue to be sky high. It's clear that the White House, through Scott Bessent at Treasury, is pushing the envelope on growth in order to be able to outgrow the debt. And that's where the fiscal stimulus comes from. And of course, that's where the pressure on the Fed comes from to keep the funding as palatable as possible. So, a lot of stuff to unpack there. And, the markets are very smart, they're very efficient, and they reprice, right? Price discovery is happening 24/7, and it happens faster than you or I or anyone else can adjust our portfolios. It's an interesting kind of dynamic to navigate in 2025. But to your point, every year seems that way, and every year seems more so than the last. But it's nothing new, and there are times where price discovery is kind of transparent and gradual, and there's times when price discovery is kind of lurches from one extreme to the other, and that's sort of where we've been this year.
You talked about how, at least for now, the bulls are winning the battle. There have been a number of things we've expected to show up. We know what tariffs are, we know what the impact is supposed to be, and yet we haven't seen them yet. Are they coming, and are they inexorable? I mean, do we know that this story must end differently and that the bulls can't keep winning?
Well, it's always a question of what is priced in, right? So you remember April 2nd, Liberation Day, the president holding this big banner thing with all of these really aggressive tariff numbers on them. The market reacted, unfavorably, as you might expect. And the president or the White House sort of retreated from that rhetoric. And that's another lesson that, the markets always win at the end, right? Whether it's the bond vigilantes or the stock market. And so the markets push back, and you got the 90-day pause on reciprocal tariffs, and of course that 90 days is now passed, and we do have tariffs, right? The tariffs did go up, and they're still going up, but they are not going up, or they haven't gone up as much as what that card showed on April 2nd. And so the markets have repriced from a worst case scenario to a much better scenario. But the tariffs are there and someone has to pay for them. But if they're manageable, like 10, 20%, I think the market can live with that, especially when there are offsets coming from the fiscal side, right? Not only in the US, but also globally. And this is now a global bull market, which actually is a very nice thing to see from an investing point of view. So the tariffs are there, they're happening. We're not quite sure who's paying for them. Certainly, profit margins are making new cycle highs as we speak, and the CPI data are not quite really showing the tariffs yet. Doesn't mean they won't. But again, it's a matter of offsets, right? Like if inflation goes up because of tariffs, but it goes down because of oil prices, then one can offset the other. And the same thing with if profit margins are pressured from tariffs, but are rising because of fiscal policy, then again, it's hard to really dissect and say, okay, this is clearly happening because of that. And that's where things get a little murky. And that's why we pay attention to earnings season and these conference calls with the CEOs and what the market's pricing in. And at the beginning of the year, the market's priced in a 12.5% earnings growth rate for 2025. In April, when we had the tariff tantrum, that got marked down to about 7%. And now, with a very positive second quarter earnings season, that 7% has gotten marked back up to 9%. So we've recovered half of it. And again, that's sort of the yin and yang of all of these cross currents offsetting each other.
You talked about this being a global bull market. We, of course, have seen tremendous returns internationally. There are some folks who think that's your rally and it's now ending, and that, again, we'll see foreign economies more impacted by tariffs perhaps than our own. Are you on the camp that that can continue and that the tariffs will not get in the way of what's been happening internationally? And where in the world do you want to be investing?
I think this, what I call mean reversion between the US and the rest of the world, has been a long time coming, right? The US has dominated since 2014, obviously driven by growth stocks, the Mag 7, but just generally growth in general, large cap growth in general. And the rest of the world was sort of a value trap, right? It was trading at a significant PE discount. The MSCI All Country World ex US is trading at about a 14 and a half forward PE, whereas the US is trading at 22, 23 times forward earnings. But of course, the markets are not dumb. There's a reason why PEs are different in different places. It's different sector composition. Obviously, US earnings have grown a lot faster than non US earnings, whether you look at developed markets or emerging markets. But something has changed where I think the playing field has become more level. Countries like Germany and just continents like Europe in general are doing more on the fiscal side. So you're getting a little bit more of a fiscal impulse in the way you've had in the US. So more spending means more growth, means higher deficits, but more growth as well. And on the other side, and again, this gets a little wonky, right? But if you look at valuation, right? So 22 versus 14 seems like a no-brainer. You buy the 14. But if the 22, if the US side is growing earnings, let's say I'm just pulling numbers out of a hat, but if it's growing earnings at 10 and the rest of the world's growing earnings at 5, then that warrants a lower PE. And so when you adjust for that in what we call the discounted cash flow model, where you adjust for not only the difference in earnings growth, but also how much of those earnings get returned to shareholders via either dividends or share buybacks, the playing field is becoming more level. So in the US companies are returning about 75% of their earnings to shareholders. About 50% of that is through buybacks and 25% is through dividends. In Europe and what we call EFA, the non-US developed markets, that number has gone from, like, let's say 50% now also to 75, but there 2/3 are coming from dividends and only 1/3 from buybacks. And so even though the growth rates are still lower ex-US, what we call the payout has equalized. And I think that creates a more level playing field. And as the fundamentals improve, that I think, it makes the pond in which we fish for opportunities much bigger. And of course, for investors, that's a really great thing because you don't want to have to say to yourself or to your clients, like, well, you can only own 7 stocks, right? The Mag 7. And if you don't own them, you're toast. But if you do own them, you run the risk that if they stop working, that you're kind of trapped in these very big, expensive stocks. So having a bigger pond to fish from is a very good thing if whether you're an active manager or a passive manager. So I see that as a lasting opportunity. And then I'll just say one more thing, and that is that obviously currency translation matters a lot in that decision as well. And the dollar has been losing strength, and I think that that's something that will likely continue. And so for a US investor buying overseas equities, and I favor developed equities over emerging at this point, again, if the dollar goes down, that adds to the incremental return.
When you look at everything that's been going on, what's your take on where the Fed is, when or if the Fed will cut rates, and any potential impact from all the talk of President Trump wanting to replace Jerome Powell early?
So I look at the Fed in kind of a formulaic, very, in my view, very simple way. So, and this comes from the old Taylor rule that the former Fed member John Taylor created back in the 90s. So it's a rules-based approach, right? You take the natural rate. So this is a real rate at which the economy is in balance. So that's generally considered to be about 1%. You add a differential based on where inflation is versus where the Fed's target is. And obviously, inflation, the rate of inflation has been coming down, but it remains, not well above, but it remains above the Fed's target. So that does not give the Fed too much license to ease. And then you add a growth differential where you compare the jobless rate to what we consider the natural rate of unemployment, what used to be called NAIRU. And there is not a lot of room there either, right? The jobless rate's 4.2, NAIRU is 4.2. So then you add inflation and you get to a natural rate. So a neutral rate, I should say. So inflation is around, let's say, 2.5. You add 1% in terms of the natural rate, you get to 3.5. The Fed is at 4 3/8. So the Fed has, let's say, 3 rate cuts that it can do to get closer to neutral. If you then look at the rhetoric coming out of Washington, which says the Fed's 3 points too high, that I think is not really warranted, because then you would get to like a 1% rate, which would be extremely accommodative at a time when the economy doesn't need it and the inflation rate is above the Fed's target. So my sense is the Fed can cut a couple of times, but the economy is not screaming for it. So why fire the bullets now if you're not quite sure how this tariff story is going to play out? And I think that's generally what Jay Powell has done. So I think they will cut in September in all likelihood. The market seems to think so. Inflation is holding up, kind of mid twos, high twos. The jobs report last week was softer. And so we are seeing a lack of payroll growth. So the jobs market is kind of in balance between the supply of labor and the demand for labor. So the Fed can probably get closer to neutral here, which means a couple of rate cuts, but really nothing more than that, unless the economy really starts to falter.
And do you expect the economy to falter here? I mean, everything you've talked about, we haven't even used the word recession until I just spoke it right there. They haven't been repealed, and we don't need a recession to have a correction or a bear market. But is there anything that is really the scary scenario that is high probability to you?
Not really. So the jobs numbers have been soft-ish. Again, you look at like the JOLTS report and you look at the difference between unemployment and the natural rate of unemployment. The labor market seems to be very much in balance here. So companies are not hiring a lot, but and the supply of labor is increasing. But there's nothing to me that is really scary. Like there's no mass layoffs. The jobless claims numbers are fairly stable. Americans are basically fully employed, and their wages are rising faster than the inflation rate. So that obviously is great news. And their debt burden is really not onerous, right? That the household debt ratio to GDP peaked in during the financial crisis in 2008 at about 100% of GDP, and it's about 70%. So Americans are not over their heads in debt. They have generally become less interest rate sensitive because so many people refinanced their mortgage back during the COVID days when mortgage rates were 3%. And so there is no really looming fiscal cliff, the way I see it, that puts the American consumer at risk. Obviously, tariffs is one consideration against that, but again, so far there is not a lot of evidence that those prices have been passed through. So, barring the consumer or the corporates, and corporates, again, they're printing very good earnings. The big beautiful bill certainly is helping with that. And so there doesn't seem to be a looming crisis there. If there's a funding problem anywhere, it's for the government sector, which obviously has a lot of debt to issue and to roll over. The US is now spending $1.2 trillion on debt service, more even than it's spending on defense. But it's the government, right? The government doesn't have the same margin calls that you and I get if we spend too much money. And so that stuff can be kind of perpetuated. And so I don't see the risk. I don't see anything looming out there that says, oh my God, I'm really worried about a recession.
And if we then had to flip that around, how good can this be? I mean, obviously, we're coming off of several fabulous years for the stock market. You talk about being in a global bull market, but if people would normally expect in bull market conditions for a market to be able to deliver roughly 10% stocks on average to do their historic norms. Is that the kind of return we can have moving forward, or is it going to be something more muted?
I think it will be more muted just because we have the juxtaposition of obviously good earnings growth on one side, but also, again, the pressure on interest rates that occasionally start to bubble up, right? Right now, we're not in that situation. The 10-year Treasury yield's down to 4.2. But what I've seen is over the last few years, whenever rates go down towards 4 or even below it, when there's a growth scare, um, it's like a beach ball that you'll hold underwater. Like it just pops back up, and I think that that will probably happen here. And then you have, again, all the funding that needs to happen, all the treasuries that need to be issued, and the Fed's not buying them, other central banks are not buying them. So who's going to buy all the debt, right? The national debt since COVID has gone up $13.5 trillion, and the amount that the Fed has bought is about 2.3 trillion. So there's a very large gap. And once in a while, you get sort of this tantrum in the bond market where the yield goes above 4.5 towards 5. And as the old saying goes, nothing ever good happens above after midnight. My version of that is nothing good happens above 4.5%. And so I think that if things get too good, yields will come back up and they start pressuring the stock market in terms of their valuation, right? So if you think about it this way, the 10-year Treasury and the S&P 500 are trading at similar valuations. If you take the yield on the 10-year and you flip it upside down into a PE, you get something like a 25 PE. The S&P is trading at the same PE as that. So when supposedly the safe asset, treasuries, becomes very competitive with the risky asset, and that safe asset becomes cheaper, then the risky asset has to compete with that by also being cheaper. And so in that sense, I think now that we're in the third year of this cyclical bull market, earnings need to kind of carry the day with less help from valuations. And I think that creates a more muted return profile, which would be understandable as the bull market gets more mature, right? We're in year 3. We're already past the median age of a bull market. This one started in October 22. It's about 35 months old or so, and it's produced an 84% gain. Historically, the average is 30 months and a 90% gain. So I would imagine the later innings looking more muted, unless you have like a bubble like ending like we did in 2000. But hopefully that doesn't occur.
Hopefully not. I have more questions for you, Yuri, and unfortunately, I've come to the end of our time, but this has been great. I appreciate it. Thank you so much for joining me. We'll talk to you again down the line.
Awesome, Chuck. Thank you very much.
That's Jurrien Timmer. He is the Director of Global Macro at Fidelity Investments. Go to fidelity.com to learn more about the firm, to find his commentaries, and more. And we will be back to put a bow on this show. So stick around. The finish line is in sight, and we'll cross it together in just a moment. We're back to wrap this one up. I hope you enjoyed that interview with Jurrien Timmer. Man, it has just been one great interview after the next this week. And we've got more coming tomorrow because we will have Craig Callahan from Icon Advisors here for the big interview. We've got Dave Sequeira from Morningstar coming to talk stocks in the market call. And we've got Kenneth Burden from Simpson Thacher, the law firm, talking about a closed-end fund case that is going to the Supreme Court and that could affect activist investors. And if you buy closed-end funds, hoping that you'll buy the discount and maybe the discount will narrow, this could affect you. So we've got all that coming on tomorrow's show. Meanwhile, if you watch the promo that we are doing for this show with Jurrien Timmer, you will notice that he's sitting basically in front of his bicycles. And, we don't spend a lot of time talking about the personal stuff with our guests, but Jurrien has ridden in the Pan Mass Challenge, which is one of the premier fundraising bike rides. It is right here where I live, basically. It's across the state of Massachusetts. He's ridden it for something like 25 or 30 years. And he's a huge believer, and he's raised a ton of money as a result. And should be admired for it, but he's very serious about his cycling. So if you're wondering, if you happen to see the video, and if you haven't been watching our videos, there's little snippets of the show almost every day. We're posting them on our Facebook page at Money Life Show. We are posting them on Instagram and LinkedIn and Blue Sky and, of course, X or Twitter, whatever you want to call it, all that sort of stuff. So now you know. I've told you what is coming tomorrow. If you are looking for something to celebrate, well, today is Purple Heart Day. And, my late father-in-law got a Purple Heart, and I know a few others that have gotten them. And just, if somebody's gotten one, thank them for their service and ask them about it. There are stories behind it that should not be forgotten. It is also National Lighthouse Day, and you may not be aware of this, but where I live, there are several lighthouses that you can find just off the shore when I go to play beach volleyball, which I do on Thursday nights, so I'll do that tonight. You can see a pretty famous lighthouse, like a lighthouse that was made famous by Mr. Rogers, of all people. It was right here. So maybe someday we'll use that as a question for a book or something. But Lighthouse Day, you want the light because today's also National Sea Serpent Day. So you want to make sure that the sea serpents are illuminated and you can maybe avoid them. And then on the food front, it is National Raspberries and Cream Day, a little less common than strawberries and cream. And it is National IPA Day.
Beer.
My son-in-law, Greg, very big on beer and IPAs, has taught me a lot. I've drunk a few pretty good ones, so maybe I've got a good one here. Maybe I'll take that with me to the beach tonight. My guests today were Todd Rosenbluth, head of research at Vetify. It's vetify.com. Derek Ober, wealth management advisor at Ober Financial, which is a Northwestern Mutual company. It's northwesternmutual.com. Direct link to the study on our guest page. And of course, Urian Timmer, director of global macro at Fidelity Investments, fidelity.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from John Morgridge, who said, "If you want to make an impact, you need to invest your time every bit as much as your money, and you need to stay involved for the long run. If you can't look at a 5-year horizon, you shouldn't get involved." But we think you need to be careful about your time for sure and invest that wisely, and also invest your money wisely and keep it all in perspective. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Ooh, somebody's